Israel's central bank kept interest rates unchanged on Monday, breaking with the U.S. Federal Reserve's last decision to tighten policy, even after the shekel depreciated almost to a 3-year. We heard in E6, the Monetary Committee left its benchmark at 4.75% for a second consecutive meeting, in line with the forecasts of almost all economists surveyed by Bloomberg. The shekel maintained losses after the announcement and traded 0.4% weaker against the dollar at 5:37 p.m. In Tel Aviv. The central bank repeated its guidance that it sees a real possibility of having to raise the interest rate in future decisions if the inflation environment does not continue to moderate as expected. In extending the pause, Israeli monetary authorities are opting to deviate from the direction taken by the Fed for the first time since embarking on an aggressive campaign early last year to tame inflation. The rate differential with the U.S. widened in July when the Fed hiked, making the Israeli currency and bonds less attractive to investors at a time when those assets are already under pressure from political unrest. Israel's central bank raised rates 10 straight times after starting in February 2022 near zero. The tightening is finally paying off, with inflation slowing by nearly a full percentage point in July to an annual 3.3%. Though a pickup is likely in the months ahead, price growth in seasonally adjusted terms is already within the government's 1 to 3% target range, according to Sagot Investment House. But government efforts to weaken the judiciary and the mass protests they've triggered have unsettled markets, feeding the weakness in the Israeli currency that risks faster inflation by making imports more expensive. A rate hike to 5% remains a possibility should the shekel continue to weaken and shift inflation estimates higher, according to Gil Buffman, Bank Leumie's chief economist, and excluding a short-lived depreciation at the start of the COVID-19 pandemic. The shekel is now near a 6-year low, so it's down 6% against the dollar since mid-July, with the worst performances in a basket of expanded major currencies tracked by Bloomberg. Those recent losses have taken its drop in 2023 to almost 8% and increased its volatility to the highest in more than a decade. At September, the shekel and the shekel's depreciation in recent months is contributing to the increase in the inflation rate, and the path of the exchange rate in the coming months will have impact on the dynamics of inflation, the Monetary Committee said in its statement. The Bank of Israel has made clear hikes aren't yet off the table, with Governor Amir Iran saying in July that rates might continue going higher if we see evidence that the inflation environment is not moderated at a suitable pace. Yaron is approaching the end of his 5-year stint, has criticized the judicial overhaul, and has said he'll announce his plans for the future around September. On Monday, the 17th city's central bank denied a report in local media that the governor was preparing to make an announcement after the rate decision about whether or not he'd seek a number term. And in an interview in August, Prime Minister Benjamin Netanyahu said he had yet to decide if he'll ask Yadon to stay on. Tighter monetary policy will increasingly act as a drag on the economy, according to Bank Hapolim. But even with a moderation in growth, the labor market is taut enough to force companies to bid up wages with unemployment just short of an all-time low at 3.4%. Political uncertainty at home and the possibility U.S. rates will rise again are also certain to make for a challenging outlook for the shekel. And while Fed officials have signaled they may be close to wrapping up, Chair Jerome Powell said last month that inflation remained too high and central bankers were prepared to do more. The next Fed meeting is on September 20th, though few analysts expect to place that soon. As long as the shekel remains under depreciation pressures, we think that the hawkish bias is likely to stay. Goldman Sachs Group Incorporated economists Tadas Gedminas and Kevin Daly said in a report, the currency remains vulnerable to domestic political developments.